making some claims that are pretty outlandish, but I can back them up. Boom. End of story. There is no other crypto out there, so don't get it twisted. If you don't understand where you're parking your money, you're going to pay the consequences for that, and that's just how the cookie crumbles. Boom. We're obliterating everybody, literally. There is nobody else that comes close to what Hex has done. Boom. Oh, it's about to get funky. Funkier than you could have ever imagined. You know, Richard Hart is a boss. Hex is literally the best thing on the planet. It's simple mathematics. Good afternoon, good morning, and good evening on this fabulous Saturday, everyone. This is going to be a relatively unique stream because we're going to talk about one specific topic, and it's not even crypto related, really. It's kind of really specifically related to Hex in many ways, but you guys will figure that out as we're going through the information, because as you guys already know, Hex is probably the closest thing that comes or the closest product that comes to mind when you're thinking about a productive asset or anything of the nature that even constitutes anything remotely closely or remotely close to a fixed income product in the legacy markets. And that's what yield curves come from. So that's what this stream is about specifically. What is a yield curve? What does it say? Why does it matter? Why do people like me care about it? And by people like me, basically talking about anybody that's a macro investor or focused in that arena of interest rates and how they make the world turn. Because as I've explained before numerous times, the whole purpose of interest rates is to kind of define the value of said monies, right? And that value is in the form of, you know, whatever that currency is based on the rate and the demand for that currency. And that demand for that currency typically comes from, you know, how well the economy is doing. Do people actually want to hold that currency? Is there a yield for that currency that makes it beneficial to certain parties relative to others? And that's kind of a function of international finance and whatnot. It gets a little funky once you get above a certain level. But you know, the interesting thing is that a lot of the things that we're going to talk about today, they're going to kind of make sense. And the reason they're going to make sense is because they're tied to reality. And that's the difference between the products that I talk about from the legacy side and, you know, stocks and shit, right? Just the regular crapola that we're used to talking about or dealing with. And that's basically stocks, right? And that's just an equivalent of a promised coin, right? When you're talking about a fixed income security, right, which is a claim on it's basically you're becoming a creditor, right? So what's happening is when you're buying a fixed income product, which ranges from the shortest term, meaning, you know, 6 months, a week, whatever the shortest term paper is you can find, it's typically a week. I think it might even be 3 to 5 days, but I don't remember anymore. We'll get into that in a little bit. But once you get from that shortest to the longest, which, if I remember correctly, could even be 100 years, depending on the country. You know, it's gonna differentiate the cost of that paper, right? The cost of that entity borrowing those funds from you, because you have to remember when you're becoming a creditor, which is what happens when an entity issues a bond, right? Whether it's a government or a person or a business, when you're taking on a loan and you have to pay interest back on that loan, that interest back, right? This is why we have to be careful now when we're talking about what it is that Hex does, because Hex does not pay interest, actually. What Hex does is it pays the inflation to the staker class because it's designed, and by it I mean Hex. Hex is designed to essentially pay out that inflation to the staker class, and that's how the coin continues to exist and survive and basically uh, cohabit, cohabit our world, right? Because that's the only way that it could exist is by finding its value and whatnot. Is that okay? Can you guys hear me? Let me know if you guys can hear me, guys. See, somebody wrote muted, so just want to make sure you guys can hear me. Um, Shout out to everybody in the chat. I know I kind of just jumped into it. Um, we're only 5 minutes in. I'll say what's up in a little bit. If anybody wants to join, let me know. I can send you the link. Nobody's been willing to join me on these type of streams, but of course. All right, good. Don't expect you to know anything because this is clearly a learning scenario for most people. Um, so again, right, the whole point of a fixed income instrument, which is where the interest comes from on a fixed income security, is from those actually conducting work to pay that capital that was borrowed back, right? So this is debt. This is what debt is for. Debt can be a tool. It can be something that's a detriment, right? It's a double-edged sword. So it honestly depends on what you're going to do with the debt. And that's, of course, a function of what you know about the market, about how you can use debt and whatnot. Like, for example, um, somebody smart will use a collateralized or an unsecured loan an unsecured loan, not a uncollateralized loan. But if you can secure a unsecured loan, for example, this is just an example, right? This is just an example. If you can secure an unsecured loan um, and just stop making payments on it, eventually the creditor will send you something that's called the discounted payout offer, right? And what that is basically an opportunity to buy that asset or buy that debt back at a discount. That discount typically ranges from 20 to 50%, depending on how delinquent the debt is. But again, right, this is debt that we're talking about, and this is a function of people borrowing, which is a function of leverage, which is just another word for borrowing. And all of these things, right, they should come to mind when we're talking about these things today, because it's all about liquidity preference, right? When we're talking about how much money costs, right? And you think about like what's happening when you're staking Hex and you're expecting to earn a yield, and then an emergency end state comes to mind, right? And you can't just get out. It's the same thing, right? And that's the thing that people kind of don't understand, and that's because they don't have that understanding of the legacy side of finance and how fixed income securities work, and how that big picture actually makes sense with respect to Hex. Because the fact of the matter is that Hex was designed to replicate something that already exists in legacy finance, right? So what was that thing? Well, that thing is exactly the thing that I'm talking about right now, and that's a fixed income security. Now, whether Richard knew it or not, irrelevant, but that's exactly what's happening, because when you stake and you earn yield, right, via the protocol of Hex, right, or any protocol for that matter, because apparently there's something like Hex out there. I don't know. The whole point is that it's just there to do what it does, and you're not a party to it in any way, shape, or form. So this is why Hex is not a security, right? And this is a tenet of the Howey test and all of these other good things that we've gone over before as far as how regulators look at securities, right? There's no intermediaries, there's no issuing body. It's literally a protocol that's immutable, exists in its own space and time, excuse me. And with that, right, we understand that this thing stands alone. For example, every effort that goes on to make this protocol known is independent of the actual creators of said protocol. In fact, rarely, if ever, are they involved, right, with anything that the community does. Now, when I say the community, I mean those persons or participants that decide to endeavor in promoting the protocol that is Hex, right? But at the end of the day, the creators and all of the parties that, give me a second, guys, this is about to get loud. Gonna have to mute myself here. All right, they went the other way. So yeah, so that's important to understand, right? Because how else can you relate something to something else that already exists if you can't understand all of the moving parts? And this is critical, right? How else do we, for example, craft the right legislation when the parties making said legislation don't actually understand the technology at hand, right? So it's kind of all of a realization that it's on us, right? If not us, then who? Because the fact of the matter is that sometimes when a cup is full, right, when somebody's cup is full, how much more can you honestly fill it up with them willingly wanting to have it be filled up even more, right? So that's to say, an old dog sometimes cannot be taught new tricks, right? That's important because the reality is that how are you going to get better at life if you're not looking at what's happening around you, right? The world doesn't stop changing, right? The world never ever stops turning. The world continues, right? Family members die, nobody gives a shit except for you. You die, nobody gives a shit except your family members. You lose your job, business keeps on running. You injure yourself, you're playing on a sports team, team continues playing. And result is the world keeps turning, right? And this is why you have to be not so much with a swivel, ahead with a swivel, but be cognizant of what's going on in your surroundings. Because if you're not, right, you're going to get blindsided. And what happens when you get blindsided is it's not a good look, right? Obviously, right? You missed what you weren't looking at. And that's common, right? That's typical. This is what is a function of the second and third and fourth order effects of what you thought was an action with no consequences, right? And this is common. This is not uncommon. This happens to people all the time. Um, so you know, this is why you have to sit there and break down. Like, there's a reason these streams run for hours on end. It's not because I have nothing else to do. It's because the information being relayed, how it's relayed, has to be relayed this way, right? Very simple. Give me a second, guys. I gotta pick up this call. Yeah, sorry about that, guys. So, just sometimes you have to understand that your knowledge base is not sufficient, and that should cause you to decide to, take action to step it up, right? Because the reality is that everybody wants to be rich, but nobody wants to take any pain. Nobody wants to endure. Nobody wants to think that there's any effort involved in that. And I'm sorry to be the bearer of bad news, but yeah, you got to kind of bust your ass. It's not going to just happen because you bought a crypto and that's it. Because, it starts with the simple fact that most people don't even know there's like only one crypto by definition, right? There's only one crypto. So what does that tell you? 99.5% of the population has no fucking idea that they're throwing their money into a black hole, right? And we see that every day, right? And that's just a function of people simply not understanding the most basic things about the things that they're involved in. And sadly enough, that's a symptom of life, not even a side effect. It's literally a symptom of living because people just rather be ignorant. And the reality is that we all pay the price for that ignorance. We all get what we want, so to speak, at the end of the day. And that's a function, again, of the choices we make, right? It's not a luck of the draw. I mean, these are things that I used to think when I just thought that there were no consequences to the action, right? That's put in, right? The reality is that if you don't sit there, sit down, reflect, and take into account what's actually going on, what what good is anything that you're doing? You're literally just sitting there baking or boiling, better yet. You're just a frog in that pot, boiling, 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 right? It's slowly, 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 then all of a sudden, kind of like bankruptcies and debt collapses and inflationary spirals and a lot of things that happen in this world that people always claim to never see coming. But if you're looking, right, you can see it. You can sure as hell see it. Hell, I'll tell you a story about my personal experience of not knowing anything and seeing the writing on the wall, right? So this takes me back to 2006, literally almost the top of the real estate market. Um, Now, I was just freshly getting out of the military and was buying my time, kind of like Motley was on his way out until it was my actual X date. So, in between that time, I decided to take a real estate salesperson course because that's what I wanted to do. I wanted to get involved in the real estate business. And what I ended up finding myself in was a room with standing room only. Now, what does that tell you? Well, for most people, it doesn't tell anything. But what that told me was, well, if everybody's trying to do this shit, it's probably not a good idea for me to do it too. That's what that told me. The average person isn't going to look at it that way. The average person is going to think, damn, this is probably a good idea if all these motherfuckers are trying to do it too. But that's false, right? The reality is if everybody's leaning one way, then you must go the other way. Period. That's a fact of life. And how do I know this? Well, just look at the headlines, right? Anytime you see a headline and you see what happened to price in a chart after that headline, it typically reflects the exact opposite message that that headline was trying to relay. Not a coincidence, folks. That's exactly how things work in life. You don't got to take my word for it. Just do your own research, right? This will confirm what I'm saying is true and not an opinion. Because again, you guys have to understand my opinion is irrelevant. My opinion isn't going to do anything for you. It's not going to put any money in your pocket. And it sure as hell isn't going to help your life improve because it didn't help mine. So I'm not going to make the same mistake and endanger anybody's future by thinking that opinions matter because they don't, right? There's a reason everybody else calls Hex a scam, but they don't have any proof to back that up, right? That's because most people just like to look stupid. I think the average Hexican prefers to not look stupid, but that's just my assumption. That there is my opinion, and that is based on what I'm seeing from the rest of the community. So, if that's not you, then, it happens, right? If you like to not be involved in what's actually going on and you like to live from a position of weakness, which is basically you not realizing that, you just don't have the information you need to be successful, right? What else do you think that's going to lead you to? Not much, right? So this is why we have to understand pretty much as possible. Because if we don't, well, who cares, right? Who gives a shit? That's important to understand. Um, what good is it to have anything that could add value to your life if you're not taking stock in what that item is and what it actually does and how it actually adds value? It's just a ghost item, really. It's just there, filling up a spot that you can't really do much with, right? And this is what people don't understand. You know, we all have skill sets. We all have things that we could use. Like, for example, I'm a mechanic, but I'd rather pay than turn a wrench because I hated being a mechanic because it was just not a good experience for me. But the reality is if I wanted, I could go outside and make money doing that right now. But I'd rather not. I'd rather starve. I'd rather not do that. And that's a function of my own decision making. So if I ever find myself in a position where I can't do anything else and I opt to not do that, well, guess what? It's my own fault, not anybody else's. It's not the world's fault, right? It's my fault. And this is what, you know, the thing people choose to not understand, right? So what I like to do is go through the motions for people, help them realize, hey, that guy that's talking all this crazy shit, he wasn't born knowing this shit. He figured it out. And just like I figured it out, I show you how I figured it out, right? We look at what is a yield curve. And once we look at the definition, let's just go to what Investopedia has to say, just because it's the most basic, obvious place for people to go. A yield curve is a line that plots interest rates of bonds or notes or whatever, having equal credit quality but different maturity dates. Now, what this is basically saying different points in time when the instrument ends, right? It's different point of expiration, different end stake date to make us understand what it's saying, right? The slope of the yield curve gives an idea of future interest rate changes in economic activity, right? Now, this is where it gets interesting because how can something in real time give an idea of future of the future, right? This is basically what this is saying. The slope gives an idea of the future. Now, how is that possible, right? Because this is kind of what this whole thing is about. Um, and we're going to get into that because it's actually very simple. But there are three main shapes of the yield curve: normal, inverted, and flat. And each have its own connotation. So it's very important to understand that. Um, you guys let me know if the sound ever goes because I'm seeing people saying that something just went silent. I don't know what's going on. So just let me know, guys, because I can't hear myself while I'm streaming. But yeah, give me a second while I take a drink of water here. But yeah, so the shapes of the curve are kind of the thing that people latch onto. And these are going to be the main topics that we discuss after we go over the basics, because this is what leads to being able to predict what could or could not happen in the future. Okay, thanks, guys, for the confirmation on the sound. So, you know, they got names for this stuff and all that, and we're not going to get into the naming conventions of what's what. We're just going to go over the basic topics of what the slopes mean from a very high level, right? What does a normal slope mean, right? What is a let's see, inverted slope mean, and what does a flat slope mean, right? Meaning no change across the board. Because you have to remember, this is all based on the fact that these instruments are covering different time ranges. Okay, so this is why this is important to understand. Maturities is a word that you really gotta you gotta really understand that that word means expiration date, right? So let's look at maturity. Maturity is the date on which the life of a transaction or financial instrument ends. That's it. That's what maturity is. Because I don't want to have to use funky words. Okay, I want to just use the correct words that I know. And the same thing about maturity is the same thing as coño. Give me a second, guys. All right. Um, so again, maturity is the equivalent of expiration date, which is the equivalent of an end stake date. All right. So I just want to use that word because that's the word I'm comfortable using, and I don't want to sound like a moron jumping in my words. So that's what maturity is, and that's the right term on the legacy side. So the shapes of the curve are what we're going to ultimately be concerned with. You got normal, you got inverted, and you got flat. Now they have connotations for reasons that are related to time. And this is why it's important for us to discuss, because right now, time is of the essence. I've been talking about this for almost the whole time since I've been streaming, right? And the reality is that you know, this weekend might be an important weekend in time. Um, and the future will dictate whether that's the case or not. And what I'll tell you guys is that some information can't be shared publicly. But it could be an interesting week, interesting next couple of weeks in the markets overall. And I'm not here to prognosticate anything, but you know, I've been talking about a market crash for a while. Um, and when you sit here and look at all of the data, a lot of things are kind of shaping in that direction. And we'll walk through some of the data points that I like to look at to kind of give me an idea of why I think that. And these are all items that are related to the topic at hand today, which are yield curves. And I did update the charts too, so we'll go over that because they're kind of important, right? Understanding that Hex is a replication of this system, right? System of earning yield, of earning income. This is what Hex is a replication of that system. And that replication is up to now almost unmatched, right? Because the fact of the matter is that everything else tries to be as good. Key term there is tries, right? Because you know everything tries and fails, right? When we're talking about system design, efficiency of the system, and everything that surrounds the fundamentals, right? Because this is what we're concerned with when we're looking at a long-term scenario, right? There's a reason people can lock money away for 15 years in Hex. It's not because it's a great short play. It's because it's a great long-term play. It's very simple, very very simple. All right, now let's see what we got here. hmm Yeah. Okay. So here we go. Normal curves point to even economic expansion, and downward sloping or inverted point to economic recession. Now, why is that? Well, this is the theory. The theory behind normal curves pointing to economic expansion is that once you look at a yield curve, give me a second because I want to actually pull one up. Um, there we go. Let's open this bad boy up. So this is the actual yield curve. Um, it's just not showing me the chart. Give me a second. Where is the chart? Why isn't it showing the chart? Did they remove the chart? I think these fuckers removed the chart. Because I'm pretty sure it was just here. Because now it's not showing anything. Yeah, I didn't think so. Hold on, guys. Give me a second. Because worst case, I might have to just build this shit. Or you know what? Um, Let me see. This is fucking annoying. Give me a second, guys. Think this isn't letting me show it because of the. Yeah. fucking fucker. All right. I'm just gonna have to look up another. I was just trying to get it directly from the source, but they like changed up everything, and I haven't looked at this in a while. So just give me a second. I'll find another representation for you. Ah, I know where to go. Give me a second, guys. I got the backup right here. So as you guys know, I'm never prepared for these things. I kind of just do them on the fly. So just bear with me as I find this information. Because again, I want people to understand that I'm like, this is all information we can find, right? Like this isn't some magical shit that is hidden from people. Like you guys need to understand that just like I'm looking this shit up right now, you can look it up and educate yourselves just as well. I'm not some freak of nature that was born knowing all this shit. That's just not how it works. All right. So just like I'm taking the time to sit here and search all this shit, you can do the same. Very straightforward. So what is a yield curve? A yield curve is a representation of fixed of all these interest instruments, all these interest rate instruments across time. And this isn't even I don't know what the fuck is going on. It's like everybody's changing their shit. Give me a second. Fuck. See if this thing wants to work. All right, so I guess I gotta freaking log in. Gotta give your fucking life away to use these stupid ass websites. Give me a second. Just want some damn yield curve data. Why is everything so freaking hard? Yeah, don't care, bro. Give me a second, guys. Make sure I'm not doxing myself or any of this shit here. All right, let's see here. Okay, so this might work a bit. All right, so what I'm gonna do is I'm gonna look at the U.S. yield curve, I guess. Assuming it's even here. Let's see. Yep. All right. So right now we're looking at every yields curve for every maturity, right? Every instrument for the U.S. dollar, for the U.S. government, right? We're going from 1 year, 2 year, 3 year, 5 year, 7 year. I don't know why this isn't in order or whatever. It's like everything is just trying to annoy me. Give me a second, guys. Okay, I guess you can't sort that. All right, whatever. I'm just gonna leave this like that. So we got 1 year through 30 years. Okay. Now, what this is plotting is the yield curve for each respective maturity across time. All right. That's a little distinct from what we're talking about when we're looking at a yield curve, whereas a representation of each interest rate, right, which is what you're seeing here, for each different point of maturity across a curve. Now, let me try another site, because I think this site will probably show what I need. Hopefully, we'll see. Let us see. God, maybe not. All right, I don't know what happened, but I guess they really don't want people to see yield curves anymore. I guess they realize how bad it's gotten. Guess I should have freaking made one. All right, let me see if I can whip something up here. It's really not showing the fucking yield curve. This is crazy. All right, well, let's try another route. All right. Let's see. I'm just looking for a good representation of an image here that can kind of give me everything I need. Give me a second, because I know I'll find one. Okay. So we got some good candidates here. All right, this is a pretty good one. Okay. No, actually, this is spreads. I'm sorry. It's not there yet. Okay, I think this is probably a good one. Yeah. So let's use this one. Um, Open image, a new tab. Oh, fuck. All right. So what am I trying to show you? All right. So this is a representation of U.S. Treasury yield curve, which is what I was trying to show you over here. Um, Going back to April 9th, 2020. So about a year and a half ago. Now, what I want you guys to notice is that down here, you don't have dates. You have points in time or durations or maturities is the best way to put it, right? Because if we go back to what a yield curve is, right, do we have the, no, we don't. We go back to what a yield curve is. Yield curve is a line that plots interest rates of fixed income instruments having equal credit quality but deferring maturity dates, right? And that's what we're seeing here. Deferring maturity dates for the same type of instrument, which is a U.S. Treasury, right? So this is a yield curve, finally, right? We'll see 3 months, 1 year, 2 year, 3 year, 5, 7, 10, all the way out to 30. Okay. Now, this line, the line down here, is the most recent point in time on this chart, which is March 2020, right? But if we look at this chart, the original yield curve that they're showing here is showing December 2013, excuse me. So about 6 years passed, 6 years and a quarter, and the yield curve has compressed. That's what this is called when the yields essentially flatten themselves over time. It's called compression in the yield curve, right? Now, number one, notice that 30 years ago, or sorry, 8 years ago, this was the best deal, right, for Wall Street that was risk free, right? Meaning that they were insured to at least get their capital back plus some yield because treasury bonds are considered risk free collateral, i.e., high quality collateral. Meaning, if you're using that, that's just as good as using cash. Still is the case today, believe it or not. And yields are basically down here still. We'll go over that in a little bit. But so what this is saying is that if you look back in time and you look to today, the yield situation has deteriorated over time, meaning what used to look risky now looks insane. Now, what does that mean? Well, if U.S. interest rates, and we can go over here and look at present day rates in a nice charted fashion. Okay, so the 30 year is at 1.936 right now. Higher than this point a year ago, a year and a half ago, right? So we went down over 6, 7 years, and now we're going up. But here's the thing. We just read that an upward sloping curve is a sign of what? Economic expansion. We just read this, right? We literally just read this. So clearly that's not true. Right? Clearly that shit there is not true. And this is why I show you guys everything from scratch, because what you're gonna get is catered. It's not real, right? This is why it's important to understand that all these things are like not by mistake; they're by design, right? So let's read the little caption here. Surging bond demand drives the price of U.S. Treasuries, diminishing yields to less than 1% until 10-year maturity. So essentially, this is saying that over the past 6 years, demand for U.S. Treasuries has driven the yield curve to sub 1% levels out to the 10-year mark. That's what that just said. So, strong signal of recession, global slowdown, worsening outlook, rise in risk aversion, aggressive monetary policy. Fed to boost purchases to inject liquidity further, driving up bond prices and reducing yield. So, all right, that was a whole lot to say a whole little. Now, what do I mean? Well, if you look back in history, this is what they'd been doing already anyway. So all they really did here was just make up an excuse to continue their party, literally. Um, so let's read this again. Strong signal of recession, global slowdown, worsening outlook, rise in risk aversion, aggressive monetary policy. All those were reasons for Fed to boost purchases to inject liquidity, further driving up bond prices and reducing yield. Kind of crazy, right? Because we just read this. So is it that everybody has it backwards and people like me are just crazy? Or is it that people just regurgitate useless information without actually verifying that it's worth what they think it is, right? Because clearly I just showed you that's not true, right? What's true is that over time, you have to watch the changing of the shape of the curve. That is what's true, right? So what am I getting at? Well, when you're looking at a whole yield curve, right? And now let's try to get this crap in some type of order. I don't know if this will work or not. Yeah, I didn't think so. Give me a second, guys. I'm just trying to get this in actual numerical order, but I don't think it's gonna work. Yeah, I don't think that's gonna work. Whatever. All right. Oh, okay, that worked. Nice. Perfect. This is what I wanted. All right. Um. So let me see something. I don't know if I can create a yield curve here. It doesn't seem like it to me. Uh, no, this is just BS over here. Mm. So check it. If you look at this here, is a good representation, right? Let's see. Nope. All right. So if you look down here, okay, you can see. Oh, actually, let me see if this. All right, this is. Huh. Interesting. So here we can see the inversion, right? Because now the 20-year is trading. Now we're gonna get to what an inversion is, right? Because we just kind of looked at it. Um, an inversion is when the slope is downward, right? And this points to economic recessions down. This is one of those things that is true, right? But again, it's about how you get there, and this is what's unique. And damn, I wish I would have looked at this site. I know this site that's pretty cool for this shit. Hold on, let me see if I can remember it. Um, no. don't know if I'm gonna find it. Fuck. It's a good one too. No, I don't think I'm gonna find it, so I'll have to look for it. But it's basically a site that lets you look at changes in yield curve over time. I should really try to find it. But let's keep going back to this just to get over the material. We can probably come back to this later. So here is the first sign, right, of an inversion, because what you're used to seeing, or what's normal, is that the further out you go, the higher the yield, right? 193 is greater than 156, which is greater than 46, which is greater than 18, which is greater than 0.76, right? Which is greater than 0.5, which is greater than 0.13, right? So this is what a normal yield curve looks like. This is what they want you to think of, right, as a normal yield curve. But what we now have is something that's no longer normal. It is now inverted and is now pointing to economic recession. Now, why is that? Well, let's think about this for 2 seconds, right? Why should somebody borrowing money for 30 years pay less than somebody borrowing money for 20 years? Makes no sense. Why should somebody lending money at 20 years earn more than somebody that's lending money at 30 years? Makes no sense. So there are the opposing views that you need to consider when talking about yield curves and what they mean and whatnot, right? That's how you take time into account here, because you're lending money in return for something in exchange. And that something in this case is interest when we're talking about the yield curve, right? So it can't be that if things are great, people lending money at 1 year are lending money at a greater rate or a greater return than those at 30 years, right? That means that the whole curve is downward sloping. And that's a problem, as we just read. And we're now going to see that in real time. But what I'm going to show you guys is what happens in markets over time once those inversions do come to the fore. Because again, why would somebody have a preference for liquidity to such a degree that you're seeing a person paying more for paper 20 years versus 30 years? That's dangerous, right? That's a what the hell is going on here scenario, because it makes no sense, right? Why? What's the purpose? How does that add value to the market? How is the market efficient when you're earning more at 20 years than you are at 30 years? It should be the other way around, should it not? Right? Like that's kind of where, how it works, right? So these are the things you got to take into account, right? When the yield curves start inverting, you start getting problems, right? Now, how does that affect Hex? Well, the fact of the matter is that Hex allows you to set any maturity you like, all the way out to 15 years, right? So while you might not be able to do 20 years, fact of the matter is that 90% of the world's paper revolves around 10 years mark anyway. So there you go. Hex does cover the gamut of product market fit by default, just based on how it works. I think that's very important to understand, because that's going to add value to your analytical perspective when you're going to understand what I'm about to explain to you right now. So here we have some yield curves, right? Or some yields, right? Here we have the 30-year yield, right, for the United States government. We have the 10-year yield for United States government, 5-year yield, 2-year, and then you have the Fed funds, which is the shortest term. I mean, hell, that thing doesn't even pull up candles, right? Because it's set by the powers that be, right? It's a centralized rate, It's the price of money overnight, in essence, right? So let's look up something and see if we can find something. Let's see. Let's see. All right, nice. All right, let's see if we can find something else. Perfect. Because we want to be able to show these inversions, right? We don't want to miss anything. All right, so I think that's enough for now. Now, you guys got to understand, this is kind of foreign, right? If you've never seen this before, you have to understand that the whole point of this is understanding why. Why would somebody give something up when they don't have to? It makes no economic sense, right? And that's critical, right? Like, nobody is out here giving away anything for free. And when the market is showing that, that's a sign, right? That's a critical sign that needs to be paid attention to. So what are we looking at here? Well, now we're looking at the 30-year, and now we're looking at the 20-year, and we can see the 20-year is higher than the 30-year by almost, well, by 4 basis points, by 0.04 basis points, right? But by 0.04%, excuse me. Now that's rare, right? Because again, why would the person borrowing at 30 years be allowed to pay less than the person borrowing at 20? That makes no sense. And it's that simple. It's really that simple, right? When you're looking at the big picture, that makes no sense. Why would that be okay? And that's where these spreads come into play, right? And I've talked about this one kind of a lot before, but let's talk about it now because it's topical, right? I even sent the screenshot about it earlier in the week because it matters, right? And this is the kind of thing that most people just have no concept even exists because why? Why would they? Right? The average person isn't looking at this kind of stuff, which is fine. But the reality is that the world turns based on this shit. So go figure. So let's look at what's happened in the world, right, over these past 30 years, whatever the data shows us here. Now, why do I look at the Fed funds versus the 2-year and not the 1-year? Well, I learned it from somebody that's classified as the best trader on the street. So I didn't question why. I just took his word for it. And so far, so good. B, when you sit there and think about it, it kind of makes sense because the Fed funds versus the 1-year, it's like, well, they're kind of one and the same. But it's like the 2-year isn't really enough of the 1-year isn't really enough of a time frame to give yourself room to maneuver with respect to economic policy, right? Because the fact of the matter is that the Fed is reacting at all times. It's not actually setting policy; it's reacting to what the market's doing. Very important people understand that. So, as always, everybody's looking left when they should be looking right, right? So let's look at 2007. So when we look at 2007, we can see that the top of this yield curve spread at that time was in April, right? April 2004, we saw 1.498, so 1.5% between the Fed funds rate and the 2-year rate. Now, reality is you can use any spread. Well, the question is that spread consistently good? Now, this has been the best spread that has been found by any participant in the market so far. So this is the one I stick to using, and so far so good, right? So October 6th, and then look at what happens. It rolls, and well, that's not rolling; it's just compressing, right? The spread is compressing because we're going from 1.5 to lower yield levels all the way down to an inverted point, right? Which occurred 2 years later, April 6th, when you went from 1 basis point to -2 on May, right? And this is, if you zoom in, because I'm looking at every 34 days right here, right? So we skipping a month basically. So in the next month we start at negative. And the market is already on its knees at that point. Like, I wasn't even out of the military yet. And by the time we get to December, we're fully negative, a whole 50 basis points, which is a 0.5%. And I'm standing in this classroom in the middle of Manhattan, standing room only. Real estate market at all-time highs. But in the background, people are really slicing and dicing trashy paper that they're offloading into the market. And I'm hoping you never figure out what the hell's going on. But the whole time, the market's at extreme levels of stress. And this is what we're seeing when price or the spread goes negative, right? This is what we're seeing, because what's happening is now the 2-year yield, right? Because the 2-year comes first, is worth less than the shortest rate, which is overnight. This is the Fed funds, right? So you can use any spread you want, but you have to understand what you're looking at, right? And I understand that this is the overnight cash rate, the Fed funds at versus 2 years. So you telling me that 2-year money is cheaper than overnight money? That makes no sense. It should be costlier to hold money or to borrow money at longer terms, right? This is what we just went over, right? We literally just went over that. So how can it be that the 2-year yield is less than the overnight rate? There's a problem. Sell everything. No brainer, right? But the thing is, we got to get there first, right? And that's what these moves are about, to the upside, right? Interestingly enough, while it doesn't look dangerous, the fact of the matter is that it is dangerous, right? Now, how so? Well, look at what happened in '99. All right, let's look at what happened in '99. Now, actually, let's look at what happened even before '99, because we had the Asian crisis, and that started in '96, working its way through '97, all the way through '98, right? And this you could see in other markets clearer than you can see it here because of where the stresses were, right? Yeah, short-term liquidity issue is correct. But again, it's about that liquidity preference, right? Right? Liquidity preference, because again, when you're saying overnight cash can earn more yield than 2-year cash, there's a major disconnect there, right? And understanding that concept is the key, because it is about liquidity, right? Typically, if a rate is higher at the shorter end, that means demand is lackluster, right? Because that's the whole point of yield, is to attract, right? The higher the yield, the more you need to attract. Need is a key word there, meaning there is a stressor involved in that action, right? Typically that happens under duress, right? And when you're looking at time frames and their weight in value is inverted, that's essentially what's happening there. That's a sign, there's a call for help. It's a sign of duress in the market, right? That means there's smoke. And this is what I want people to understand, right? Now, what we're seeing is we're seeing it at the long end of the curve. And the long end of the curve is the most sensitive to interest rate changes. Okay. Now, once we're looking at that, I'll get into why that matters then. But for now, let's look at the shorter end and understand the ramifications. Give me a second, guys. All right. So again, 97, we're positive 20 basis points. Then all of a sudden, Right? You're negative. Boom. A whole month later, 34 days is all it took. Right? A damn near polar opposite move of 35 basis points from 20 basis points positive to minus 15 negative. And that's all because of the stressors in the market. Liquidity preference, what people were willing to pay for and not pay for, right? And then the market quickly snapped back. But again, that was a stress move because look at what happened thereafter. It came right back, right? Like not even a whole year later, right? From January 98 to May 90. So 5 months later, this happened. Right, you went from inverted to not inverted to inverted again, all within the same 6 month time frame. That's almost like I've never even realized that until now that I'm talking about it. That's how uncommon it is. Like that's crazy. That doesn't happen often. So then you have the what's it called? The tech bubble, right into 99. And look at what the curve does. It uninvert itself and normalizes into that top, which occurred literally right here in between February and April is literally when the market topped out. But look, you didn't get a warning this time. This time, the market topped out right in between here, and that was just it. And then the curve inverted, right? Like really well into May. So it's all right. Let's break this down. 21 days. Let's see here. Let's see. All right. So here we got 99. That's the top, March. It was literally March 6th, 2000, but there you go, right? March 1st, March 30th, April 28th, right? April 28th, we 47, 48 basis points positive. Then by May, we're already negative. The market has already topped out at that point. So you're late to the party if you're not anticipating in certain instances, right? But there you go. And the market it bottomed out almost around this time. So liquidity preferences started to normalize, right? And this is all it is. It's kind of like a barometer for the market and short-term liquidity preferences and how the market is feeling, right? It's about security because the market needs to feel that complacency which is represented in the lack of volatility, right? When you see the VIX do nothing for long periods of time, for those of you that watch that, I don't know which one is the right one, but we'll see. Um, Alrighty. Give me a second, guys. Alright, let me move this thing. So when we're talking about volatility, complacency is when the market is down here. Right? That's literally complacency when it's just below a certain level, because you know it's just going up and to the right, and that's it. It's not doing anything else. When it's above these ranges, it's above here, right? Or it's spiking up into those ranges. Better yet, let me speak appropriately. What's happening is that price is now behaving out of character, right? That's what's happening. So not only is it when price is spiking up or volatility is spiking up that price is getting out of character, but when volatility is compressing once again, it is going back into character. And it's important to understand that because until I understood that, you would kind of chase trades, and that's when you end up, buying tops and selling the whole, right? Both ways, and that's how it works. You have to understand what the market is telling you at all times. It's really not the market's fault; it's your own. So let's look at some spreads, right? Um, let's see here. Let's take this US 30. Let's throw a 20 on there. Okay, let's go 1 day. This is crazy. Okay, so they just started posting this data about a year ago, year and a half, May 2020, right? It's November 2021, and it's basically been a one-way trade. Let's throw some candles on this just so to see what it looks like. Um, and if it's okay, there you go. That's better. Um, but that just goes to show how drastic the most recent move has been in terms of where it is, right? And that's on the number line because we're literally reverting now, or inverting, better yet. And that's what happens when the spread, right? We just saw this. Excuse me. We just saw this at the spread of the 2-year in the Fed funds, which is the 2-year yield for the U.S. government bond minus the overnight cash rate. So now we're looking at the longest end of the U.S. yield curve, which is the 30-year minus the 20-year, and it's at minus 4 basis points. Now, what this is saying is that you're better off borrowing at a longer term if you're a borrower and lending at a shorter term if you're a lender. Now, that makes no sense. Typically those need to match up. Now let me just throw this in here. So, this thing is just not as fast as my computer. All right, so let me just make another spread here. All right, so this one's still positive, but look at what it's doing, right? And this is the point. It's about the change of the slope, not the shape of the curve. Now, professionals understand this, and this is a little bit advanced, and I don't want to go into it because it's weird words and weird terms, and they're confusing, and it took me years just to wrap them around my head right. But the whole point is that you have to understand the shape of the curve is not positive; it is negative, right? So what that means is that what's coming is typically not positive; it's negative because you're seeing compression. Because what's happening is that the longer term rate, right? Because this is the one at the beginning of the calculation, is compressing versus the shorter term, right? Because that's the end of the equation, right? So if you take 10 minus 5, that's 5. But then if you take 8 minus 5, that's 3, right? And that's what we're seeing here. You're going from point 0.8, right? Point 0.3, basically. Same conversation. Going from one yield level to the next yield level versus one instrument and another. So it's just a spread, right? And the spread compressing is saying that the demand for one side is greater than it is for another. And that's typically the front side and this side, the 30-year yield. So that means people have a liquidity preference that's longer. It's they're seeking safety and yield, basically. Right? This is what this is showing. Now, the interesting thing is that this, in this instance, and let me just break it out 21 days per candle, just so we can get a bigger picture, just so you can see what it looks like in normal points in time, right? Because what we're seeing now is not normal, right? Now, what I want you guys to see is what's happening here, because this is every time there's been a recession or some kind of economic stress in the market. That's what these down spikes are, because if you look at what's happening here, what's showing here, it's zero, right? So we're going from positive yield here to negative yields here, meaning the liquidity preference is changing once again. Right now, what do these down spikes coincide with? Well, they coincide with recessions again, right? Not a coincidence, guys. Right? You had savings and loan back here, Black Friday. You had what's it called? Black Friday here, whatever. I don't even remember the name. Black Monday anymore. All these days are black and shit. You had all these, economic situations that came to the fore because of the liquidity concerns in the market, right? Shout out to you, Kyler. Know you're out there working hard, brother, getting your hustle on. But these are important things to understand. 94 again, right? Russia was an issue, or I can't remember who it was exactly. What did happen in 94? Let's see. This is, I don't remember. Ah, peso. Yep, there you go. Mexican peso. Tequila crisis is what they called it. In fact, if you ever seen The West Wing, they even talk about it there. So there you go. So again, 99, 98, 2000, tech bubble, Asian crisis, right? Russian crisis as well, which rolled up into the Asian crisis, which then rolled up into the tech crisis. And here, the real estate crisis that started in the U.S. and spread all over the world. Here is same thing. Just give me a second, guys. This is Wales only. Glad you guys can make it out. I'm making some claims that are pretty outlandish, but I can back them up. Boom. Sorry, I was on mute. They finally went away. Sorry, but it was just getting crazy. All right, so this is 2008 when things again were slipped. Right, this was already before off the cliff. This was just further falling. Um, and this, right, what is this showing us here, right? Because now this negative slope should show or should lead, right, to some negative action, but we've yet to see it, right? And we've slipped a couple of times into what's negative, right? We slipped a couple times, right? This one into 2014 and this one into 2018. But the interesting thing is that economic issues did happen, right? You're just not going to remember. Like China was having severe issues here. And I think it was China again here also. Let's look. Oh, it was Europe in 2014. That's what it was. With the Euro crisis that was never ending. Let me see. Yeah, I think it was a brick crisis or whatever. Can't remember exactly. Okay. I guess it was Russia. I mean, it's so frequent. Like you have so many issues all over the place that it's almost impossible to keep them all wrapped up in your head. So let's see, 2018. Let's see. Oh, okay. I mean, yeah, that's whatever. When is in Italy an economic crisis, right? Um, yeah, I don't know. I feel like this isn't giving me a comprehensive. Let's see. Turkey. Okay, yeah, I remember that. All right. Yeah, Chinese stock market too. Yeah. So yeah, there was a lot of shit going on, and this is the thing. Like, there's always something going on that's gonna cause something somewhere. So it gets a little funky, right, when you're trying to keep track of all these things because the market is connected globally, right? When something happens one place, it's gonna affect some other place, and that's called contagion. And that's I was trying to share that word with you guys a while back. I couldn't remember. Thanks, Artenium. Appreciate the 20, bro. Save it for Wednesday, homie. But what's happening now is again, right? We're falling into the same concoction, right? We're about to hit potentially zero again, right? We got close in 2018. There's a lot of stuff going on then, and now we're skyrocketing back in that direction, right? Again. Now, the question that should pop up in your mind based on the basics that you know up to this point is, well, if the slope's been negative for 10 years, well, why hasn't anything bad happened yet? Interesting question. Now, let's take stock of what is actually going on in the world, right? Because this is how we know whether bad things are happening or not. Excuse me, because what you have to remember is that the way to define it is by how a stock market is doing, not how well you are doing economically, which is clearly what should be the defining measure, right? And yes, this was yield curve control, but is understanding the reality of that, right? Because that's the thing. You had these players, right? And that being the moneyed interests, as RG likes to call them, doing their thing, right? Buying fixed income securities here, buying fixed income securities there, stating, and as you guys have seen lately, they've been coming out that they've been caught insider trading, right? Which is interesting because the Congress is allowed to insider trade, and these guys tell them what to do. So it's kind of weird that they seem to be getting in trouble for that when the Congress can do that. So it's kind of perplexing, but maybe it's just another scenario of them trying to get you to look left while you should be looking right. And as you guys know, we're always looking where we're supposed to be looking around here. So not much of an issue for us, but interesting to discuss nonetheless, right? Because the question is, well, what's coming if the curve is taking this move, right? What is actually going on in the economy that is taking this dive, right? Because we already see we got one inversion already. Are we going to get another one? Because this would be the next one, right? This literally went from 40 basis points or from 25 to straight negative. What's to say this can't do the same thing? Why not? It's done it before. Hop, skip, and jump away right from this level. So the question is, well, how does this actually impact us? Well, fact of the matter is that at first it could negatively impact us because you're going to always have those actors that are going to move in concert with the market. But eventually, what should happen is that people are going to realize this is a safe haven asset, right? Hex is a safe haven asset. We don't actually, hold on, because we have to remember nobody knows about this thing yet. This thing is brand new, right? 2 years old. And people are buying it, right? No matter who is selling it, people are buying it. And that's the whole point. There's constant demand, right? That's why when I start with the charts, it always starts like that. Because the sellers literally, in order to get out, have to dump it. Have to dump it. They don't have an option. Because if not, price is just going to continue to go higher, right? Literally. Chart shows it, right? Even on a pullback, it's just like nothing. Now this chart is showing the first 684 days of each asset class, right? You got Ethereum, Bitcoin, and T shares in conjunction with Hex on this chart, right? Each in their respective colors, right? And you can see the legend up here. And I've also thrown trend lines here, power trend lines to depict their log-based nature, right? As you guys can see, the log-based nature for T shares is this gold line, and that is log-based 2, and this is log-based 10 for Ethereum. Now you guys have to understand how these charts come to be on this graph here. I don't put them. The data either represents them by allowing this trend line to become shown by Excel, or it does not, because the data isn't there. For example, the one for Bitcoin cannot be produced because it's not sufficient data points to yield the trend. So that's how that works, right? So when you're looking at the performance of Hex, you can just look at it like this. It's 104 outpacing Ethereum 104 to 27, outpacing Bitcoin 104 to 4. And that's without taking T-shares into account, which is essentially a double. And you guys know what the T-share rate does. Only goes in one direction. So, right. Yeah, it's funny you mentioned this guy. He knows about Hex. Tries to ignore it. Tries to act like it doesn't exist when he knows it does. In fact, after I made my first video, a week later they came out with their own, saying the same thing I was saying. Funny how that happened, huh? Well, good thing they have a bigger audience. Hopefully they learned something from my video that they replicated. So here we have Hex post big payday. And as you guys just saw, market ran up, right, into big payday, or into the first day of November before big payday, and then it sold off. And then it's just been nonstop up ever since, right? And this is what we're seeing on this chart. But right now we're down to 4,354 on the index for Hex post big payday, which is kind of crazy. And now Bitcoin is moving on up to 2,352 on the index, and is actually capturing new highs after it was down and out for a while. Now this is the first halving, right? Now this chart is showing Hex post big payday relative to Bitcoin at each halving, and the most recent one is the green line. And as you guys can see, not a really great performer. So hopefully it picks it up. You know, what are you gonna do? What are you gonna do? Hopefully Bitcoin steps it up, because as you guys can see up here, we're dusting it in every aspect. So you know, it's kind of crazy, but the math does not lie. And here we have T-shares in dollar terms versus Ethereum and Bitcoin in dollar terms. And you know, we're still at 100% basically. And at 9% of a Bitcoin, T-shares is the 99. T-shares versus ETH is a 99% figure in pink, and T-shares versus Bitcoin is a 9% figure in orange. Sorry guys, I keep smacking this damn roller on my mouse. And we have T-shares global market cap, or T-shares market cap versus Hex price, and as you guys can see, 48 billion market cap for T-shares. Versus a price as of last night of 22.5 cents. And that led to a total value lock per staker of 205,000, basically. So a little pullback, but as you guys know, we're it's only a matter of time before the sellers run out of ammo. And I got a chart that's showing exactly where this Hex is going, right? Because the fact of the matter is that somebody's buying all this Hex. It's not just going onto the market, right? It's not just pushing the price down because there's millions of Hex sitting on the market. People are actually buying this Hex. And we got a chart that shows that. Here we got a little stock to flow tracker for Hex, showing the dollar cost of a T-share as of last night's crossover. Give me a second, guys. It's fucking all day over here. All right, I think it's safe now. So got a dollar cost of a T-shirt, $4,371.69. Dollar cost of 10,000 Hex at $2,263.49, with the T-shirt rate as of last night or this morning of 19,150 hex per T-share, with a APY of 37.01%, with a percentage of staked coins at 9.9%. And of course, this is as a percentage of all coins in existence, not the circulating supply. Let me just get through these charts, guys. Please save your questions for later, so I can just get through these charts. And here we have, again, the same chart, but in this chart, we have the forward T-share rate, right? And as I've shown before, the forward T-share rate is just this number divided by this number, which yields a one-digit number with decimal. And that, when you multiply by 10,000 as a base rate, yields this number. Now, the system is giving us this 19,150, whereas the market is giving us this. Now, when you take the difference of the two, what you get is what I like to call a T-share basis. And that value is essentially what you're overpaying based on demand from the market in real time, right? Because when you're buying Hex and you're staking it at that crossover point last night, that's what that cost you. It didn't cost you what the system is saying it did. That's how the system is tabulating what you're getting in terms of a T-share. But the fact of the matter is in dollar terms, that's not what you paid, right? I mean, we earn and we pay for things in dollars. So until we can actually change the system to Hex terms, that's how we have to look at things. So this chart helps us do that, right? And if we look at how this has been sloping up, well, this is positive for those that are looking to stake at a good rate, because once it goes to zero, that means you're in line with the market. Now, this means this T-shirt rate is going to jump up more than likely, much quicker than this will go down, because it's just how the math works. And this chart is a T-share payout sum line relative to the Hex price. And this orange line is essentially the quantity of Hex paid out per T-share since inception. So we're almost at 3,000, just 6 Hex away. We're probably going to hit that tonight with 5.75 as the average, right? That's going to take us over the 300 Hex mark, or 3,000 Hex mark, excuse me. And we're hitting that line. I mean, anytime we hit this line, it's typically a bounce. We typically bounce from there. So it could get interesting. It could get interesting. Give me a second here, guys. Gotta light up. So Hex payout index metrics. Now, this is 271% to the staker class since day one. What do you think institutions are going to do when they find this quality of consistency, which is something that's unseen before, right? What? What and why, right? 'Cause that's important, right? We're talking about a yield curve, right? A yield curve points to interest rates of equal credit, but different maturities, right? And we all know what maturities are now. So when we're looking at this chart and we're seeing that no matter what point in time we pick, Hex is going to do the same thing. That's freaking powerful. Like, you guys cannot comprehend how powerful that is. This system is so riskless, it's crazy. Because taking on price risk is irrelevant when you're earning 40%. It's so irrelevant. So irrelevant. Then on top of that, the system is providing you the security of increasing the value of your stake every time somebody ends theirs. I mean, the game theory could not be better. It incentivizes people to stay in the system no matter what. It's a beautiful thing, guys. It's a beautiful thing. As long as you understand it and you treat it with respect and you act in line with the properties of the game theory and the math, which is in line with the game theory, you literally cannot lose, right? The reality is that the people selling are selling to people that actually want what's being sold, right? All of this volume It's transactional volume. It's a two-way trade every time. I want people to understand that. Every time somebody's buying, somebody's selling. Every time somebody's selling, somebody's buying. That transaction is never one-sided. This is powerful to understand because otherwise you're going to be left hanging high and dry thinking that something is happening that is not happening, right? That's critical, right? What are you going to be left with if you get carried away by exiting a position you shouldn't exit based on misinformation, right? I mean, look at this chart. I mean, what I got in, we were here. It's been a year. At the start of the year, we were here. Here. Now, in Vegas, which was a few months ago, excuse me, we were here, right? Basically 6, 7 cents. I mean, you know, oh, that was a lie. Sorry. Whacked out a little bit. And I thought we dipped while we were in Vegas. We did, didn't we? Yeah, pretty sure we did. So this is probably a little Vegas dip. Yeah, I'm pretty sure that was like the day I left. 'Cause I remember thinking, yeah, that was probably it. But again, right, we were just here. May, April, March. You guys got to understand, you know, markets happen in a transactional fashion, meaning that A to B to C to D to E is how things happen. It's not just A to Z or A to E, whatever you want to call the endpoint. Critical. Because every time there's a transfer of value, there's risk involved in that, right? I think it's important people realize how important that is, right? This consistency that you see, right, is unfounded, right? This is why this exists. Now let's go back to this. That's why this exists, guys. This is inconsistency. This is a function of inconsistency. Okay? I want you guys to realize that. This VIX is a measure of volatility, and that's a function of inconsistency, right? Anytime it spikes up, right? And any spike up is negative. It's negative for what you want from the outcome of what you're doing when you're buying and you're holding a stock, right? So here it's the inverse. A spike up is positive for us. So different, right? And we don't have any downward spikes. What we'll have is a gradual grind down if it does move down, because the assumption then is, when I saw a question which I will answer, which is coming up next, you know, how does the T-share payout go up? The only way the T-share payout goes up is if there's less people or less T-shares. Only way. Because what that then means is that you're entitled to more of that inflation, because the system is always going to print that 3.69% inflation. The question is how many people are going to be earning it based on the shares in the system. And that's the reason you stake 15 years. Eventually, all the short stakers are not going to be able to afford a T-share. They're only going to be able to afford shares in the form of a B, M, K, H for 100, whatever the share count is. It's not going to be 11 million shares at some point. It's going to decrease. Now, when that value starts decreasing, it's not going to be because of a lack of interest. It's going to be because of the expensiveness of a T-share. So with that, you'll start to see an increased count in the Hex payout per T share because there's going to be less shares, less T shares to spread them across. Hope that makes sense, because that's how that's going to work. Until there's less people able to hold the shares, that's just what it's going to be. It's just going to be a ever winding grind lower, or a flat read of 575, but it's going to be this. And that's pretty much it. And this consistency of payout, right? That's so important, because that removes this concern of volatility, right? Now, what you guys might not know is that even for bonds, there is such an index, and it's called the Merrill Option Volatility Estimate. And all that is that it's basically the estimate for the bond market. And here's a good explanation. Um, did you know that there was a similar index that measures fear within the bond market? That index was developed by Merrill Lynch and is referred to as the MOVE index. That index rises as concerns grow that interest rates are on a march higher. The index will rise more sharply when there are fears in the market that rates may be headed significantly higher, as was the case during the 2013 taper tantrum. And this is what we see here in 2013. And all that is just that people thought that the Fed was going to remove their, never-ending quantitative easing measure. So there you go. As you guys can see, it exists for the bond market as well, but it reads almost like the VIX does, right? A spike higher means stress, and the stress here is in the form of capital loss, even though it is counterbalanced by an increase in yield, right? But here it's different. Here, the increase in yield is not a function of a down move in price, right? Think about that. Think about how important that is, right? You don't have to worry about a jump in yields being related to price here. You can just earn money. What do you think is going to happen when institutions figure that out? You think they're not going to figure out a way to jump into this shit? Better believe it. They're going to be late, but, good for them. Better late than never. That's what I say. What up, Jenkins, man? Hope you doing good, brother. Um, and this is important to understand, right? Like, you don't ever have to worry about your payout being a function of price. Price is going to be a function of supply and demand strictly. So we got a chart that highlights how the dumpage is so bullish, it's not even funny. It's coming, don't worry. Everybody gets paid chart. So here's just an amalgamation of payout per T share averages, right? And the all-time in yellow is 4.3. The 28-day is 5.789. The 55-day is 5.896. And as you guys can see, price is kind of might travel back into this range. We'll see. Be interesting if it just stopped here at the 55-day level, but we'll see. It's a little bit lower than that mark so far at 21.12 cents, and this was 22.63. So we shall see. Correlation charts is always zero between both Hex and Ethereum, or Bitcoin and Ethereum, between Hex. And if you haven't, please go watch my correlation stream. That'll go into detail. Not gonna waste much time on this anymore. As you guys can see, zero, right? Returns are positively skewed, as the returns for Hex on the x-axis are primarily on the right side of the x-axis, whereas for Ethereum, it's all over the place. Same deal for Hex, or I'm sorry, same deal for Bitcoin over here. Returns all over the place. Hex primarily right side. Correlation again is zero. And these are the best performing asset, or the top two assets in the space, right? Those are the ones everybody knows and loves, but not the best ones, turns out. Now, what you might not know is that a zero correlation is everything, because you can't find that anywhere. Period. No, you just can't. So, rolling correlations: T shares versus the price of X. Now, this is the price of T shares versus the price of X, and as you guys can see, interestingly enough, 55-day correlation is still one. So is a 21-day and a 34-day. Interesting. Wonder what's going to happen when price decides to turn around. Guess we'll find out. All right, this is the dollar term chart. Now everything here is just price in dollars, right? The price of Hex, payout per T share, and the adjusted value is just the sum of payout per T share and the price of Hex, and that, as you guys can see, gives us a count of 1.53 cents. So as you guys can see, we already breached the $4 mark from that perspective. So it's literally just a matter of time, because the payout per T share is honestly just a leading indicator, right? And I got a chart that shows how that's true, but you're going to end up seeing that that's the case. Um, and the thing about it is the bigger the gap gets over time, the quicker and nastier the snapback gets, right? Because value doesn't disappear here, right? There's been dips before. This won't be the last dip. This is just one of the many, right? And the fact of the matter is that nothing's changed with respect to how the system works. So clearly, it's just people selling out because they want to cash out, and that's fine. They just don't know how to sell. If they did, price wouldn't be down 60% against the sellers, because the buyers are just buying. They're clearly not getting out until they're ready. And most people that enter Hex are long-term minded, even if it is just for 60 days or whatever, right? Like, it's not going to be a quick, 20-minute flip. It's not going to be a day trade more than likely. And that's kind of important, because that's how you can guarantee that you're not going to really strip yourself of earnings, right? Because sometimes all you got to do is have some time in the market. It's not about when you get into the market, right? And we talk about this on Quan Gang all the time. It's not about timing the market, it's about time in the market. And that's very powerful, because once you have time in the market, you can give the market time to correct itself if you got in too early or whatever, right? Very important to understand all the aspects of the game that you're trying to play in. Not having the rules is a problem, right? Or not playing by the rules, right? So it's important to understand that, right? I mean, price ran up to 50 cent and we rolled back. But as you guys can see, price ultimately always comes back to where the pink line was. So ultimately, we're going to hit this dollar mark, right? Because we hit that 50 cent mark. And ultimately, we're just going to keep doubling. I mean, it's just what it is. The system can't not do that. And this is why, right? Hex price to earnings ratio is what tells us that the payout per T-share is a leading indicator, because that's what that's measuring. It's measuring the payout per T-share, and the payout per T-share is saying that you're going to get your money back within 17% of the year. And that's it. No more. So, take it as it is. It's just math. And the all-time low for the S&P 500 was 5.51 times, meaning you wouldn't get your money back for 5 years. So in October 1917, if you invested in the stock market, you weren't seeing your money back until 1921 or 22, sorry. Right? That's crazy. That's 5 years and a half, not even. So 1923, right? April, May 1923. That's when you would see your money back. Something to consider, right? And Hex, you see it every 64 days as a base case. Still somewhere around here, right? We're still in the cents area until we break out the buck, really 50 cents and up. We're not going to start seeing some elevation. Now this is current holders. I've changed this up. I used to have it as total holders, and here we have current holders versus Hex. Now the line is getting flat, which is interesting. But as you guys can see, anytime price is below current holder count, that's typically a good buying time. So the question is when? Remains to be seen. Same deal with the staker class, right? I mean, rarely is it ever below. So this should probably snap back at some point. I mean, you guys know how Hex moves, man. It just reverses in instances. Like, it's kind of crazy. You know what I mean? And yes, I do hog, bro. Yes, I do. Get your own. Now I've changed this chart up a little bit. This is a current staker to current holder chart at 26%. So for every 4 stakers, there is, or for every 4 current holders, there is at least 1 staker. Now this orange line is a current holders versus total holders, right? So a downward slope means that we're losing current holders or we're gaining total holders, and it just depends how you want to look at it because it's just a ratio, right? It's just a ratio. So it could be that total holders are slowing down and current holders is slowing down more, right? Which is then causing the ratio to roll over. But it looks like that this was an airdrop of some sort here, really, and the market is just recalibrating. That's what it really looks like to me, but who knows? All honesty, right? Who really knows? Current versus total stakers, this is good because it's actually up. And as you guys can see, retention, basically, staking retention is one way to look at it, is at 81%. Um, and what that means is out of every 5 people, 4 continue staking. Pretty interesting stat. And thank you for the super chat, brother. I appreciate that, man. Appreciate you guys. Thank you guys for sticking around this long. We're almost wrapping it up here. This is a circulating supply versus current holders. And as you guys can see, even during this dump, right, the price, or shall I say the supply that's circulating, has essentially just gone away, right, to the tune of almost 400,000 during this dip. That's crazy. People are selling millions of X. Millions. How does supply just reduce itself to that degree? How about that for bullish, right? Like, all of these coins are getting dispersed to holders that are staking for at least the average, right? Like, you got to assume that they're going to stake for at least the average. If not, right, whatever. But those coins are disappearing somewhere because it ain't like the holder count is growing like that, right? We just went over that. So, um, I mean, current stakers, current holders. So you guys see that the rate of growth in that demographic is not one to lead to this type of dip. So clearly, these coins are being disappeared in the form of some type of T share or something, right? Like they're just being bought up and they're being put away because they're disappearing from the market, and that's the whole point. Same deal, staked hex per staker, right? It's just like what we were just looking at, circulating supply per holder. Except in this instance is what's actually staked per staker, and that number continues to decrease as well, meaning there's just less hex to go around. So this is just another sign, right, that this is crazy. Supply is just disappearing. Again, payout in hex terms per staker, current staker, right? And that number keeps going lower because, again, the supply just continues to disappear. So all of this is trending in one direction, but price is trending in another, right? Ultimately, price has to recalibrate itself with reality, right? And that's what's important to realize here because this is supply that's disappearing and it's creating these other second and third order effects. And this is where we're at versus the forecasted chart. And this is again, actual is giving us a representation of every 49 days, which is based on the last doubling point, which is September 9th, based on when Richard Hart tweeted. Um, and from that point on, we're counting every 49 days for the actual in blue, and every 64 days for the base in magenta, which is the same thing as the PE rate. That's where we're getting that number from. So 17.4% multiplied by 365, right? And that gives us 64 days. And the math to get 29 days or 49 days was the number of doubles divided, or the number of months at the time, which was 21, divided by the number of doubles, which was 1.6 something, multiplied by the number of days in a month, and we just used the number 30, or I used the number 30. And it gave me 49 days, and that's just how I'm counting it. So we're already past the 49-day count, so we are essentially having until November 12th to reach that 93-cent target. Now, here's the thing. Hex does what it wants, right? It's completely correlated from everything. As you guys can see, it went sideways for months before it actually picked up, right? So could easily do that again for no reason this time, because we didn't get a 7,000% move, right? We just got this little move here. And I say this little move because that's what it is. It wasn't a 7,000% move, right? So it's important we understand that. So this could literally just go sideways and then just all of a sudden catch up, right? Like, I think it's important people understand that. So, all right, let's start taking some questions, guys, because this is pretty much it. Just charts and pretty much done. Let's see here. Do you think November 12th will happen? Yeah, I think it's possible because, again, right, the sellers can't sell forever. Like, it's literally not possible. They're gonna have to run out of ammo at some time. And hey, you know what? If we're lucky enough for this to keep going down, I'm gonna tell you what, man. I'm gonna be one happy camper because I know in a couple days I'm about to sell that shit. So, or should I say buy that shit? Because what I'm gonna sell is fiat. So, you know what I'm saying? That's it. That's pretty much it, right? Because this is what it is. Let's see. Yep. How could you not, right? How could you not? You know what's happening with the data, right? And that's what matters, because this is a long-term game, right? Like, look at all the people that are, whoever's billionaire off of Bitcoin is because they just held it and didn't do anything with it for forever. It's not because they were trading it. Important you understand that. Very important. Because that makes a difference. Right. Appreciate you, brother. Yes, I do. Yes, I do. I don't actually know. I don't actually know. I think they have whoever the other one is has 3 stakes left. 100-day, 200-day, and 555 or something like that. I don't really know. I don't really get into all of that. To me, it's not really relevant, because you're always going to have buyers, you're always going to have sellers, and the market's just going to react how it reacts, right? And that's pretty much it. Um, so yeah. All right, guys. If you got questions, lay them on me. If not, I'm gonna wrap them up. If you want to use my charts, yeah, they're on my website. So knock yourself out, man. Um, you see the downside pressure ending in Jan, since a lot of stakes. And yeah, that's the thing, right? Like, a lot of the time, the stakes that are messing up price flow are the short ones, like the small ones, not the big ones. The big ones typically restake. The small ones typically do not. So hard to say. It's hard to say. Yeah, this is the best period for onboarding, in my opinion, because that's the whole point, is to get people to get as many hacks as possible, because morons are selling, right? You want to be able to take advantage of that. That's the key. The key is to take advantage of people that don't know any better, right? Yeah, I know. It's so ridiculous. I don't know, who wants to give away a double? I mean, this is a free double by just holding it, right? Like, people are selling, given the reality that there's about to be a freaking snapshot via a fork, right? Like, once that happens, that's it. Like, you just gave up all that hex you sold. I don't get it. Maybe they just want to start their life now. They don't want to wait on Richard. Who knows? Right? Like, that's really the only reason I have been able to come up with. But of course, as you like to say, we appreciate their sale. Yes, we do. Not mad at all. Cause I got some fiat coming my way, baby. Oh yeah. It's gonna be nice. It's gonna be real nice. Let's see. These really big stakes I see coming in, they're probably just testing the system. And the thing about it is like, big stakes aren't positive for us because they diminish the payout, right? So that's the funny thing about Hex. The less people that know about it, the better it is, actually, because you make or break whatever you earn here, right? Like, it's all based on whatever it is you want to lay out into the system. It's not based on anything else. If you don't want to put up a lot of money, you're not going to earn a lot of money, and that's it. If you don't want to hold it for a long time, you're not going to earn for a long time, and that's it. Simple as that. What up, brother? Hope you're doing well out there, man. Let's see. Explain why the price of t-shirts can't go lower. So the price in dollars can do whatever the value happens of it in dollars, right? Because even though the t-shirt rate always goes in one direction, that's in hex terms. So because the price of hex is going down, right? Because the t-share is, again, quantity of hex, right? So right now the quantity is 119,150 hex times 0.02112 cents. Let's go with that. So that's your cost of a t-shirt right now. All right, let's go to GRAPHHEX and see what it says there. And it says it's 4,063. So same difference, right? $20 difference. So there you go. Now you know how to calculate the price of a T-share, right? And that's it. Yeah, yeah, exactly. 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 Yeah. Don't mind being new. I had to learn as well. I only became this good because I asked questions and I made it my business to learn exactly how Hex works. So, like we were going over earlier, right? Those curve inversions are something to concern yourself with, because they're going to lend themselves to things happening in the future. And the question now becomes, well, now that this is ripping, right? We're going to find ourselves in territory that was familiar. But what happens after that? And that's the question that we need answered, right? Because it's hard to say. Right here's the spread versus 1 year, and it's not as long history as I'd like it to be. It's only going back to 2009, but as you guys can see, you get a lot more false signals, is what it is, because the stressors are going to be shorter, right? Because it's 1 year paper here now that we're looking at, not 2 years. So that's the reason why. Yep, correct, correct. 2024, not sure, man. But I got stakes ending that year, so hopefully we'll be in double digits, if not triple. But yeah. So that's the gist of really yield curve inversions and why they matter, right? Hex is gonna basically it's basically a replication of this whole yield curve situation, because we don't even have to look, right? We don't even have to look for 30 years. Excuse me, guys. We don't even have to look at 30 years. Because, like I told you guys earlier, the reality is that the rest of the market is focused really in these three areas: 5, 7, and 10 years. Like, most commercial business happens here. So a whole new ecosystem could literally be built based off of Hex. So, it's just a matter of the rest of the world catching up to reality. So there you go. Yeah, it depends, right? So let's see. Let's look at this because we were talking about this the other day. There's a way for you to check that's easy. Um, let's use USDC. Let's go 20 million USDC. 1, 2, 3, 1, 2, 3. It will bump up the price 65%. So not a million, but 65%. Because what's gonna happen is the system is gonna have to recalibrate to this price because that's how much hex is available. And that's it. That's all you get. So if it was 2 million, it would bump up the price to 25 cents. So there's your difference. Let's see. Yeah, it's a lot, man. Take your time. Don't feel rushed. Took me a while to figure it out. Yeah, I mean that seems to be the case because there's not much more benefit to it than that. And unfortunately, that's all we're really seeing, right? I mean, the T-share rate is flying up because here's the thing: the T-share rate is a common. It functions as a combination of two things: um, how much is being staked and for how long. And if it's not for a long time, then it's going to take into account how much. And these big stakes are going to trigger that check, right? So those checks for how much are going to look, just as like a big, what you call it, is coming out. Like a big stake is coming out from a long time ago, just not as impactful, right? Because it's still a big stake, right? And that stake is going to earn ROI. And it's going to earn more ROI than a normal stake would, even though it's for a small amount of days, because of the basic fact that it's earning much more yield than a normal stake would because of the bigger factor. Remember, longer pays better and bigger pays better. Those are the two things that affect the T-share rate. Yeah, it's looking like we're not gonna hit that $10 level, right? We'll see. Because if Hex has taught me anything, is that you can never count it out, right? Like it'll do the craziest moves. Let's look at what I mean. Um, Now that isn't to say it is gonna hit $10. 'Cause I don't think it's gonna hit $10 now, but that doesn't mean we won't hit $2, which I still think is possible. We hit 16 days for 100%, right? In April. That was the start of the big bull run for us in Hex. Right. But before that, we have 27-day pump, right? 200%. Before that, or after that, excuse me. This is kind of a medium pump, medium pump. Let's look at this one. Well, it kind of topped out here. 39 days, but it really kind of just went straight up for 30 days. And that's a function of, how Hex moves. Because again, once people find it and there's something happening that's negative elsewhere, like people are gonna find this thing and they're gonna buy it and stake it and all that good stuff. Um, and that's just what we end up seeing in the data, right? Like we went over this data a little bit earlier, and you guys can see some upticks around that time. Let's see here. Yeah, matter of fact, right around here, you can see that this just starts dropping off, right? That can't be a coincidence, right? I think it's important to realize that because that's just a function of markets and how they drag and how value isn't just value transfer isn't instant, right? Because while this hex is disappearing, what's happening is that people are staking it, people are doing this, people are doing that. We had the whole sacrifice business, all of this stuff happened during this time, right? When we started at that run, right? And this is all what's happened to supply during that time. It's not a coincidence, right? And here we go again. Current holders, right? It's not like they exponentially grew either. But you'll see that when price took lifted off here, this took off as well, and it was already gradually climbing, right? And it just climbed a little bit more. So it's important to understand that Hex could really, really like shake shit up, right? And then it's also important to understand that we just got this big move after something similar to what's happening right now, which was big payday, right? We literally did like I don't know how many thousand X's after big payday, right? Like we literally did like, let's see, why not calculate? 15,870%. So there you go, right? Because we literally went from 0.003 cents to 50 cents. I mean, come on. How many X's do you want? I don't know. I'll take the ones that I got. Because I basically rode that whole wave. That was all post big payday. Right? All of that. So we'll see. Because we could easily get another move like this. The year isn't over. I won't say that it'll happen in 30, 45, 120 days. What we got, like 60 days left in the year? Yeah, we got 60 days left in the year. We won't see a move like that in 60 days. But if this thing post chain gets announced within the next 60 days, there's literally no telling what could happen. If that happens, all bets are off, right? Because there's literally no telling what could happen. So let's see if we got any more questions. I kind of rambled on that one a little bit. Would you say that for the holders with Liquid Hex, holders waiting to stay PLS, better to get a better deal lower? Not really understanding your question. I'm guessing you mean that if it's better to wait to buy PLS instead of swapping for EHEX or something, or uh, to stake on PLS. Oh, yeah, I got you now. I got you. Yeah. So, I know the chain could take a while to come out, right? So keep accumulating EHEX. If you want to stake, right? Ultimately, I understand the fees are ridiculous. But if you want to stake, right, just stake it if it's for long term because you're going to make that money back, right? In a matter of months, you're going to make that money back. If not sooner, if Hex does reverse. Because if this thing does reverse, it's going to reverse and it's going to capture the buck pretty quickly because that's just how it moves. I mean, come on, 300 days and 100, 15,000%, 16,000% in 15 in 300 days. That's 10 months. So, respect the math. My pleasure, man. Yeah, this is probably a good range, $2 to $3 end of the year. You Probably not because they're literally trying to destroy it. I'm not sure people realize that. They're literally trying to destroy the economy. So, you know, hard to say. How liquidity works. That's a pretty broad question. So I'm gonna guess you mean with respect to liquidity pools and how markets trade and stuff. Um, I'm guessing. That's what you're getting to. Yeah, definitely watch video one. Thank you, Patty. Definitely watch video one because that's a good one. That's really the very base case of all crypto knowledge right there. Luckily for me, um, it's a really good way to learn. But liquidity is essentially how much is sitting on the market, right? Like if you look at this right here, it's saying there's 11 million hex and 554 ETH sitting in the liquidity pool for V2 right now. That's what this is saying. If we switch this to V1, you'll see that these numbers change. 165 hex in the liquidity pool over there for some reason, and 9 ETH for some reason. Guess the yield is good. I don't know. But there you go, right? So now you see that those values are distinct for a reason. And that's because that's a function of people's interest in providing liquidity there. What up, Dorsey? Um, so if people want to provide more liquidity, that could mean that I like desktops and mini PCs. I don't really like laptops. As far as brand goes, hard to say because everything is pretty much a Chinese trap nowadays. So good luck. Unless you're building it yourself, you're kind of stuck. So there are some good sites for that, but I don't remember them off the top of my head, unfortunately. Sorry. Mm, yeah, man, gas fees are fucking crazy. Like, there's no other way to talk about that shit. Like post chain, yo, when that shit drops, they might start coming for all of us with guns because it's gonna be crazy. It's gonna make them folk go broke so quickly, so quickly, so quickly, so quickly. Let's see. Yeah, so when I do gas fees, what I do is I literally set them at a specific value. So what do I mean? Let's see what is looking like right now. Probably freaking insane because that's just been the trend, and I'm afraid to say it's not gonna improve because that's just not what's been happening. But we'll see. Hopefully, I'm wrong. So yeah, liquidity, right? Um, Liquidity is better in crypto than it is in regular markets. Why? Because in regular markets, it's all algorithms, it's all robotic, it's all electronic. So they operate based off of what the market is doing. So it's reflexive, isn't it? And it's instantly reflexive. It's not like it's humans. So when the value that was there to trade is no longer there, it's gone. It's it. You're screwed. So that then means it's an illiquid market. And that's kind of basically liquidity in a nutshell. So as you guys can see, it's 150 or whatever. So what I would do in this instance is I would just set the GUI at 100 and let it rock because you really don't have much of an option unless you want. Because even if you use Matcha, for me, I still have to pay for whatever reason. So I don't know what people are talking about. They don't have to pay. I still have to pay. So I don't know. Maybe it's the browser wallet, whatever. I don't know. Let's see. What else is next? What other questions we got here? Boom, boom, boom. So yeah, let's talk about post-chain sacrifices since people are sacrificing so much still. I don't understand why or how, but people are still doing that. Yeah, I don't get it. Um, I checked. I calculated the rate the other day. Is like you're getting 1/144 uh, of what we were getting at the beginning. So you're getting nothing basically. I mean, I think you're getting like 144 points per dollar at this point. Like it's abysmal. Like that's what that means. Um, it's crazy. Yeah, I mean, this the next pump is gonna be insane. Yes, it's gonna be insane because this is the longest we've ever gone sideways and down. It's the longest outside of big payday. This is the longest. Outside of big payday in this period of time right here, this is definitely the longest. Yep, this is definitely the longest. It's crazy. This is the longest. I think I calculated the average one time to be like 21 days or something like that. We're almost at double that right now. So since we doubled, we're at 50 days, like I said yesterday or earlier, whenever it was. And since we topped, we're at 41 days as of today. 41 days. So there you go. So there we go. There's a view on a sideways price action, right? And if you go through all of these, they're all going to be shorter than a month. This was sacrifice, you guys know, 3 weeks. Yeah, this is like 3 weeks too. Shit's getting messy. Sorry, guys. This is also about 3 weeks, 2 weeks, whatever. Um, this was also 2 weeks. And this is also about 3 weeks. Oh, this is 30 days. So there you go. So there's your sideways price actions and whatnot. Um, all right, let's see what else we got here. Uh, let's see. The U.S. dollar plummeted today. How would I mean that would send Hex to the sky, to the moon, because it would if it's priced in dollars for us, and the value of those dollars decrease to rapid rate, it has to increase the value of Hex by default. Um, that's just by default. That's just math. Let's see here. Oh, we're doing well, bro. Pleasure, man. My pleasure. Maybe, right. Maybe. I don't know if I think he's there already. Yeah, he should be there by now. He was leaving like the next day, I think. That's insane. I hope we didn't pay for that shit. Shit will stay right there. Yep. Not at all. How long until price of fuel is the same as price? Guessing you mean on pulse chain? Mm, I think it'll be a long time before we get there. To be honest with you, because the unit bias doesn't allow it to really jump up there. I mean, you have to realize the cost of a transaction on the Ethereum chain has been divided by 10,000. So it has to traverse 10,000 levels before it could be equivalent and even more expensive. So something to think about. Dun-dun. Let's see here. Sorry, guys. Okay, there you go. There's your answer. I didn't know. Uh, yeah, I don't know. It's hard to say because we're gonna have a lot of people involved that aren't hexagons that don't have diamond hands and are ready to sell at a moment's notice. So it's hard to say. Yeah, there you go. It is disgusting. Yeah. I didn't check. I don't actually know. Um, let's see. That's it, baby. That's it. Yeah, y'all can read that. I don't understand all that. I don't. If it's that hard, I don't need to. I don't need to be involved. That's my motto. My brain is better served using thinking of other shit. All right, this is the last question, and we out. How much longer can they prop the dollar up? Well, I think at this point, it's beyond their control. I think at this point, once everybody else figures out what the hell's going on, it's game over for them. That's what I think. Mm, hard to say when that'll be, though. That's the problem, right? Because it's kind of a market decision, and that's why it's hard to ascertain when that'll happen. Um, but yeah, sure, sounds good. I don't mind. I'll take an 80% dip. Buy a shit ton of hex with that. So I welcome it. Yeah, it's exactly tied to the miners. All right, well, there you go. They sacrificed 573K. So we out, guys. Thank you guys for tuning in. I hope that yield curve inversion, yield curve conversation, help you guys understand a little bit about what's going on in the macro side of things. Yeah, that's pretty much all I got. Peace, guys. Let's get this little outro music going for y'all. Peace out. This is Whales Only. Glad you guys can make it out. I'm making some claims that are pretty outlandish, but I can back them up. Boom. End of story. There is no other crypto out there, so don't get it twisted. If you don't understand where you're parking your money, you're gonna pay the consequences for that, and that's just how the cookie crumbles. Boom. We're obliterating everybody, literally. There is nobody else that comes close to what Hex has done. Boom. Oh, it's about to get funky. Funkier than you could have ever imagined. You know, Richard Hart is a boss. Hex is literally the best thing on the planet. It's simple mathematics.